Welcome to This Explainer. I am so thrilled to have you here today because, look, we're tackling a topic that is absolutely critical to the entire global economy, yet it is wildly misunderstood by pretty much everyone outside the profession. We call this the expectation gap. And today, we're diving deep into the Vietnamese Standard on Auditing 200, or VSA 200, to completely close that gap. Our whole goal here is to demystify what an audit actually does and uncover the real story behind those financial numbers. Let's get started.
I want to kick things off by just asking you this fundamental question. Does an audit guarantee a company is literally 100% fraud-free? You know the drill. A major corporate scandal hits the news, billions are gone, and the very first thing everyone screams is, "Where were the auditors?" Right? People just naturally assume that a signed audit report is this ironclad, absolute guarantee that every single penny is accounted for and no one in the entire company told a single lie.
Well, we need to shatter that myth right now. The answer is a massive, resounding no. An audit does not provide an absolute guarantee. What it actually provides is what VSA 200 calls reasonable assurance. And really, this is the cornerstone concept for our whole chat today. It means an audit provides a high level of confidence, a very high level, but it is never, ever an absolute guarantee. So the really crucial thing we need to figure out is what this reasonable assurance actually means in the real world and why absolute certainty is literally impossible.
To get there, here's our roadmap. We're going to cover the true goal of auditing, management versus auditor responsibilities, the auditor's essential mindset, evidence and audit risk, and finally, the inherent limitations of audits.
All right, let's jump right into Section 1, the true goal of auditing.
Let's completely clear the slate of our preconceived notions for a second and look at what the actual standard says. The core objective, pulled straight from the text, is this. The purpose of an audit is to enhance the degree of confidence of intended users in the financial statements. Now notice what's totally missing from that sentence. It says absolutely nothing about being an infallible fraud detector or a financial police force. The goal here is simply building trust. It's about taking these financial statements and adding a really rigorous layer of professional credibility to them. That way investors, board members, and the market can actually make informed economic decisions without second-guessing every single number they read.
And to build that confidence, the auditor goes looking for reasonable assurance. Again, that's a high, but not absolute level of assurance that the financials are free from material misstatement. Think of it kind of like going in for a doctor's checkup, right? You get a clean bill of health because the doctor gathered evidence, blood tests, heart rate, all that stuff to form a highly educated conclusion that you're healthy. But they can't travel back in time to witness every single meal you ate all year, and they certainly can't guarantee you won't catch a cold tomorrow. It's the exact same thing here. The auditor gathers substantial evidence to form a highly educated opinion, but there is just no way they can witness every single transaction a company makes.
Which brings us right to Section 2, management versus auditor responsibilities. Blurring the lines here is basically ground zero for public confusion.
We really need to draw a hard line in the sand between the two. Think of it this way. Management is entirely responsible for building the financial house. They prepare the statements, they pick the accounting policies, and they set up the internal controls to stop errors from happening. The auditor? Well, they're just the independent inspector walking through that house. The auditor doesn't write the financial statements, they don't fix the broken pipes of a bad accounting system. If the house is fundamentally flawed, the auditor's job is simply to report on those flaws, not to grab a hammer and rebuild the thing themselves.
In fact, VSA 200 makes it super clear that an audit literally cannot even begin unless management acknowledges they have to provide unrestricted access. We're talking access to personnel, all the accounting records, and whatever extra info the auditor asks for. Because honestly, if management hides the keys to the house, the auditor can't do their job. It's the absolute bedrock of the whole engagement.
Okay, with the ground rules set, let's open up the toolkit in Section 3, the auditor's essential mindset.
Being an auditor isn't just about knowing math. It's a very specific way of thinking. And the standard mandates two key mental frameworks here. The first is professional skepticism. This is basically an attitude of a questioning mind. It's staying constantly alert to conditions that might indicate a misstatement and critically assessing the evidence. Just like a seasoned detective, an auditor takes nothing at face value. Now, they don't assume management is inherently evil or dishonest, but they definitely don't assume they're perfectly honest either. If a document looks a little weird, or if two pieces of evidence completely contradict each other, professional skepticism is that alarm bell ringing in the auditor's head telling them to dig deeper.
The second framework is professional judgment. Auditing is so far from just checking boxes on a clipboard. It requires actually applying relevant training, deep knowledge, and years of experience to make really informed, subjective calls.
Let's say a company estimates their new heavy machinery will last for exactly 10 years. Is that reasonable? The auditor has to apply their specialized expertise to evaluate that claim. They decide what evidence is needed, what risks are lurking, and ultimately whether the financials are fairly presented. There is absolutely no way to automate this level of nuanced decision-making. Moving right along to Section 4, Evidence and Audit Risk. Let's look at how that skeptical mindset is applied out in the field.
First off, what is the auditor actually hunting for? They're looking for a material misstatement. This is an error or omission significant enough to actually influence the economic decisions of the people using the financials. It is absolutely crucial to understand that auditors are not digging through the trash for a missing $5 coffee receipt. They just aren't. They are hunting for massive material errors that would fundamentally change the picture for an investor. If a multi-billion-dollar company misclassifies $100, nobody cares. If they hide $50 million in secret debt, okay, now that is material.
And to find these material misstatements, auditors rely on an equation called audit risk. Let's cut through the accounting jargon for a second. First, you have inherent risk. This is just the natural, everyday chance of a mess-up before anyone even tries to fix it. Really complex calculations? Volatile industries? High inherent risk. Next is control risk. This is the risk that the company's own internal safety net completely breaks down and fails to catch the error. And finally, detection risk. That's the risk that the auditor's own testing actually fails to spot the issue. So the auditor evaluates the first two risks, which belong entirely to the company, to figure out exactly how much work they need to do to lower their own detection risk.
And how exactly do they lower that risk? By gathering evidence. But here's the catch. Not all evidence is created equal. VSA 200 demands that evidence be both sufficient and appropriate. Sufficiency is all about quantity. How much evidence do you need based on the risk profile? Appropriateness is about the quality, the relevance, and the reliability of that evidence. Listen, a mountain of low-quality internally printed receipts does not even come close to equaling one highly reliable independent bank statement. You could hand an auditor 1,000 pages of weak evidence, and it still wouldn't be enough if the quality just isn't there.
All right, we finally arrive at the climax of our explainer. Section 5, the inherent limitations of audits.
These are the real-world reasons why that absolute assurance we talked about earlier is basically a fantasy. I mean, why can't auditors just verify every single dollar? The answer lies in some inescapable practical constraints. First up, the subjective nature of financial reporting itself. Accounting isn't pure math. It's full of estimates, forecasts, and human judgments that are inherently uncertain. Second, there are practical and legal limits to what an auditor can do. If management carefully conceals a well-orchestrated fraud with expertly forged documents, well, an auditor might not catch it. They're accountants, not handwriting experts. And third, balancing timeliness and cost. The market demands financial reports fast and at a reasonable cost. If an audit literally checked every single transaction, it would take years to finish, and it would bankrupt the company in fees alone. But the ultimate limitation, the big one, is simply this. Audits are not legal investigations. Seriously, auditors do not have police powers. They don't wear badges, they cannot force confessions, they cannot execute search warrants, they can't subpoena the CEO's personal bank accounts, and they certainly are not designed to perfectly detect sophisticated, collusive fraud where a bunch of executives actively conspire to lie to them. They operate purely on a professional level of evidence gathering, not a criminal investigative one.
So let's step back and reflect on this final, pretty provocative thought. Let's tie everything we've talked about back to the real-world value of an audit. If an audit has all of these limitations, if it isn't a 100% guarantee against fraud or error, why on earth is it legally required? Why is it considered the absolute backbone of global business? Why do investors even care?
Because at the end of the day, reasonable assurance is the ultimate trust builder. Even without absolute magical certainty, the highly rigorous, structured, and skeptical process of an audit provides exactly the critical level of confidence the market needs. It drastically reduces the risk of major blowups, it enforces strict discipline on management, and it provides the exact reasonable assurance that allows modern global markets to function, invest, and ultimately thrive. Basically, an audit doesn't have to be perfect to be incredibly powerful. Thank you so much for joining me on this explainer today. I really hope you now see these financial numbers and the people who actually check them in a whole new light. Catch you next time.